Hey, quick note, Ricky Caruth on YouTube made a phenomenal review of his shadowing experience with me. So if you're interested in that, learning more about me or my personality and what I'm like in real life, or those programs on building your wealth, linked down below. Use that flash sale. We've got a 69% off discount for you on all the programs on building your wealth. The most common right now are 0 to millionaire real estate investing and stocks and psychology of money, which come with trading, fundamental analysis, long-term analysis, my thesis on the market, Q&A with me and daily market open live streams, and in the Elite Hustlers course, we've got custom live streams on the weekend. Now, folks, we've got to talk about PCE. The personal consumption expenditures numbers come out in about 20 seconds. Prepare for the expectations. PCE month over month is expected to be 0.5, by some estimates 0.6. Year over year 5.0. Core month over month 0.4. Year over year core 4.3, and the numbers will be coming out within the next 10 seconds. This is gonna move the stock market today. Let's see what happens. It's been like 10 seconds and it's still not out. Waiting. Usually they're pretty on time. There is out. Personal income comes in at an actual of 0.6 versus the survey of 1.0. Personal spending, however, comes in at 1.8 versus 1.4. So more personal spending, but less personal income. Here we go. PCE numbers in month over month, slightly hot at that 0.6, although some estimates did hit that. Year over year comes in hot, 5.4 versus 5.0. This is just like the January CPI report all over again. Core, that's not good. Core comes in at 0.6. That's 7.2% annualized. That's terrible. The prior read was 0.3. And the last survey was 0.4. That's a nice beat in a negative way. Core year over year comes in hot at 4.7. Okay, now we got the revisions. Year over year core of the last reporting period, so December, was revised up from 4.4 to 4.6. Core deflator month over month revised up from 0.3 to 0.4 for last month. Year over year revised up from 5% to 5.3%. PCE month over month for the last report revised up from 0.1 to 0.2%. So what do you have? Well, you literally have people showing now, these new reports showing less income, more spending, and higher inflation than anticipated by survey, and certainly higher than what we had last month. So much in line with the CPI report. It's not good. It's all hotter. It's all hotter than expected. And no surprise, but at least at this point, the market is taking a little poopsie doopsies. Now, I have to just put my own little spin on this for a moment while we pull up the PCE report and we go through some of the details here. Personally, I'd just like to say that I feel like this is redundant. I feel like this is just a redundancy to what we saw in the CPI report. But for some reason, we have multiple of these reports, like PPI reports and PCE reports. I get it. So it's no surprise to some degree that this one's coming in hot, because we had the heads up that it was going to come in hot via the last, again, the beats on PPI, the beats on retail sales, the beats on CPI. Okay, now that aside, let's see what Wall Street is saying about it. Obviously, it's an algorithmic, easy sell trade. It'll be really interesting once the humans actually start reacting to this data, if we end up buying this dip. That will be very interesting, because I want you to know right now, it's algos firing off. It's a very simple formula. If expectations or the results come in higher than expectations, sell. If they come in lower than expectations, buy. Very, very simple algorithm you could program probably yourself as well. So not too terribly much of a surprise, again, that this data is hot, but hey, whatever. 61 economists okay, here we go. Only 6 of the 61 economists surveyed by Bloomberg forecast a personal spending gain of 1.8% or higher. Another hot January report, no question. Yep, agree with that. PCE core accelerated to 4.7% in January, above all estimates, and the month-on-month gain matched the high forecast. Inflation again coming in hotter than expected. Okay, we've talked about some of the headline numbers here. Let's go to the actual release as well and see what they've got here. So here's the actual report. So what do we have here? We've got personal income For January, there we go, 0.6. Personal disposable income, 2.0% on current dollars. Expenditures, 1.8. So again, this is where you could see we're spending more than we're making right now. And this kind of reiterates what we're seeing with the credit card data, right? The credit card data suggesting people are spending more than they're making. And this is where there's a lot of, I like to say clickbait because I like to say it's kind of just like basic, but like there are a lot of folks going, oh, but Kevin, the personal savings rate has plummeted. Yeah, no shit. Like we're probably going through some degree of a recession. So people go into their savings that they have and they spend money to get through the recession. Businesses do that and people do that. No, duh. People's incomes go down in a recessionary environment when stocks go down and when, people are getting laid off. Duh. So showing the chart of the personal savings rate going down is just, it's redundant. It's like childish. It's simple. What we need to pay attention to is how much excess savings people have. And most people still have 4 to 5 times as much money as they had before the pandemic. So we have a long runway of still being able to spend through this. I'm not saying that's a good thing. It's actually one of the reasons we're seeing some of these inflationary numbers come in hot, obviously combined with the fact that you've got crazy seasonal adjustments that happen in January. So February is going to be even more important because January is like seasonal adjustment month. But whatever. Obviously, this is a hot report. Obviously, that's not good. Obviously, this is not the trend that we want. And obviously, that's why the stock market is taking a little poopsie-doopsie immediately after the report. However, I want to see how the day evolves because I'll tell you, one of the most important things that you're going to get as an investor in the stocks today is if the stock market ends up green today, that's a sign, in my opinion, that institutions realize we're not going to get Paul Volckered, and any dip is starting to turn into a buy the dip opportunity. Now, I'm not saying this dip is a buy the dip opportunity. I'm just wanting you to observe the market today. And if for some crazy reason we somehow rebound from negative 1.5% on the QQQ to positive at the end of the day, it's a sign that institutions are realizing, oh damn, we've been off sides for too long. It's time to start allocating more cash to these levels. Grab these before they're gone in February when maybe those seasonal adjustments are gone. I'm not thinking it's all in time because obviously if we get a hot Feb, you're going to be like, oh, why did I buy? Right? Hot Feb would be like worst case scenario because then you're reiterating the January trend and the argument that January is just a seasonal adjustment disaster, or maybe January is hot because January was a lot warmer than December and people are buying spring clothes in January. That goes away instantly. Look, I don't know. I mean, if you follow me on Instagram, it's basically at this point like following my OnlyFans. Okay, I don't have an OnlyFans, but on Monday I was skiing without my shirt on because it was hot. It's like February in Lake Tahoe, and I'm like, I'm sweating my butt off over here. And even after I get, splashed with snow, I'm still hot. It is weird. It's like, it's a weirdly warm winter. I know obviously that's just an anecdote, but that is also what we're seeing in the data, right? So that motivates you to buy different clothing, right? And then leads to more retail spending and people have more. Anyway, okay, so take that as you'd like, but obviously pre-market here, and maybe at the beginning, market open, whatever, we get some red. If we continue to close red, okay, then this is a legitimate concern. If we actually rebound like we did yesterday off of this, because yesterday was insane. I mean, yesterday was just like straight down and then just like straight back up to close higher basically than where we started today. Insane. But anyway, what do we have here? Here. Increase in personal dollar income in January was led by compensation, reflecting private wages and salaries. Obviously, these are just the lagging embers of inflation. No surprise. Government social benefits decreased in January, reflecting a decrease in other benefits. Fine. One-time refundable tax credits, Social Security, COLA adjustment. Oh, that's another thing to remember too is you have the COLA adjustment that took effect in January. So people's incomes actually rose thanks to getting more Social Security money starting in January. Remember when they announced the COLA adjustments and like when do they do it? Like September, August or something like that. They're like, oh yeah, 8.7% bump. People were like, oh great, inflation is wonderful. My Social Security is going up almost 10%. Obviously inflation's not great, but anyway, that could be what we're seeing some of in January as well. COLA, cost of living adjustment, not Coke, okay? Anyway, so what do we have here? $312.5 billion increase PCE reflected spending on $162 billion in spending for goods, $150 for spending for services. Within goods, the increase was widespread, led by motor vehicles and parts, as well as other non-durables. Durables are like cars, washing machines, dishwashers, and stuff. With services, the largest contributor for the increase was spending for food services. That's interesting because food services is actually part of core, but food is not part of core. See what I'm saying? So it's like, even if food increases, and then you're like, oh, well, I want to look at core, which takes out food and energy, you still have food services that are affected by food prices. And so if food service prices go up because they raise menu prices, that's an increase in basically food services. And it's related to food going up, even though it's supposed to be part of core, which is excluding food and energy. It's the same thing as saying like, my delivery fee for my new gym is $100 more expensive because gas is high, but my gym shows up as more expensive on my CPI report, even though the core CPI says, here's your gym without the energy costs, right? So you can see how in like food and energy, which is very volatile, still continues to flow through even in core. But anyway, personal outlays increased, personal savings decreased from prices from the prior month, blah, blah, blah. Okay, real. Okay, let's see here. Let's look at some of the other data or related materials that we have here. Full releases and tables. Yes, this is what I want. Let me get this up. In the meantime, let me quickly see what Wall Street is saying. PCE reflected an increase in both goods and services. Spending, food led the way. Yeah, see, they're picking up. Wall Street's picking up on this as well. Hey, they just picked up on that 30 seconds ago. Maybe they're watching us right now. Hey, fine with me. Hey, if you're watching me, hi. Anyway, so there was really no disagreement across the raft of indicators in January. Strong for the economy, jobs, consumption, inflation. Will this be sustained? That's the big question right now. A lot of strategists right now talking about, is this a re-accelerating of inflation? Is this the second wave that everybody's been fearing? That's maybe why the stock market is falling and then sort of selling off a little bit right now. Yeah, that is a very fair question. That's why the report that comes out next month for February would be so important. Okay, is there anything else interesting in some of this data? I do think that food services item was very, very interesting. And quite important. No, not really. I mean, we'll get some tables here. Oh, yeah. Okay. This actually will be really, really interesting. So let's go to, I want percentages. Please give me percent changes because now we can see categorically what's happening. Oh, dear. I'm dying. Here we go. Percent change from preceding month. This is so bad I'm like choking and dying. So here we go. Wages and salaries. Oh, good Lord. 0.9% seasonally adjusted monthly rates. That's absolutely horrible. 0.9. Good Lord. You realize how high a 0.9 read is? Oh my goodness gracious. It was 0.4 in November and December. 0.9? I mean, this is going to make people scared of a wage price spiral. That's 10.8% annualized. But again, some of that has to do with like cola going up. But damn, 0.9, that's bad. Personal interest income. Wow, with rates this high, you're sitting at 0.1% of an increase. That's nothing. Personal dividend income. Boy, that's a volatile category right there. Rental income of persons with capital consumption adjustment. I don't even know what that is. We can figure that out. So this is percent change from prior month. Some of these numbers are just nutty. What is this? Personal contributions from government social insurance. Yeah, there you go. Look at that. 1.5%. I mean, that's a massive boost. That's the COLA adjustment taking effect. Okay, can we get percentages on like specific goods? Maybe. Food really popped off over here. Percent change. This is from a year ago, 1 month, but a year ago. This is from okay, yeah, I mean, that's fine, 11.1%. That's sort of what we've been expecting for food. This table, not too terribly insightful. But let me see a little bit more of what Wall Street is saying, and then let's try to... Fed swaps, okay, yeah, here we go. Fed swaps are now fully pricing in rate increases in March, May, June. Yeah, we've kind of been expecting that already, though. 3 more 50 basis point hikes, right? That brings us to 5.25%. So from 4.5% to 4.75% in the next meeting, to 5 in the next, and then 5.25 in the next. Yeah, that kind of is what we've been expecting. So the question now is the terminal rate moving up? It probably will on this. The terminal rate was before this report at a high of 3.7 or 3.3, what am I saying? 5.37 was the terminal rate before this. And okay, it's moving up a little bit. There's now this expectation that potentially there's a rising risk for a 50 BP move in the next meeting. I disagree with that. I think if anything, they would just add a 25 BP, or the market will start pricing in a 25 BP for July if it needed to. But I don't really, honestly, like, bottom line on all this, I don't think this really changes anything, because again, it's just like, it's literally like replaying the nightmare of personal consumption, or PPI, retail sales, and CPI for January. It's literally like we're playing the same movie over and over again for January. Like, we get it. The January numbers are hot. We get it. Like, how many more times are we going to play the same movie over and over again? It's like watching the Titanic on repeat and being sad that people are dying. It's literally what these reports are. It's over and over and over again for January. It's the same crap. We get it. January was hot. I know. It was hot for winter as well. Next month's data is going to be very important. We want to break this trend, because the last thing we want is all of these reports next month to be confirming this trend. That's what matters at this point. I don't think this changes anything in terms of the Fed going for 25 BP next meeting. I don't think there's any way they go for 50. I'll you know, I don't know. I'll make we'll have to make some kind of bet on that, because I feel so confident on that. But sure, you know, like if this stuff is a trend, it's bad. If it's not a trend, it's a buy the dip opportunity, which I still believe that we want to pay attention to what the market does today, because even if it's super red at open, if it recovers towards the end of the day, the institutions, and they could be wrong too. Institutions are wrong all the time. Institutions could be yelling at you going, "This is the buy the dip opportunity," especially if that boost happens towards the end of the day. Remember that most ETFs do their transacting at the end of the day. So if you get, well, that could also be representative of some retail inflow, since ETFs are an institution, but they get both retail and institutional investments, right? But often if you see big inflows at the end of the day, or big kind of moves up or down at the end of the day, it's usually institutions pulling the trigger. So they come up with sort of their strategy for the opening bell and then the closing bell. So you usually get the most volume at those times because of the institutional strategies going in. Kind of interesting. Kind of fascinating. Play the buy the dip video. Well, let's see what happens throughout the day. See, but remember, you know, like Alex Kerr here says, disinflation is transitory. Poor JPOW. This is just a reiteration of the same crap from January, right? Like this is not a trend. QT. Yeah, look, Steve's talking about QT. You know, yes, the Federal Reserve is quantitatively tightening right now. It's similar to what we saw in 2018 and 19 in terms of the runoff, the contraction of the money supply. The contraction of the money supply from an Austrian economics point of view could actually be providing us all of the evidence we need to suggest that inflation will end up being transitory. Yeah, I mean, that's part, what nobody really knows how quantitative tightening is really going to affect the broader market. Nobody really knows. And I think that's why the Fed is going as slow as they are on that. They don't want to break anything. So we'll see. It'll be really interesting. But yeah, it'll be fascinating to watch the institutional reaction today. Watch how the market closes today. Obviously, 10-year Treasury yields still holding on to that 3.94. We saw a pump when in real estate when Treasury yields fell to 3.3% because people were under the impression that this is it, this is the bottom. I'm like, not so fast. We'll see. Bottom's not in yet for real estate, in my opinion. So, you know, I don't ever want to come across as like I'm only a bull. Like, I'm definitely bearish on certain parts of this economy. But anyway, we'll see what the next data sets show. But in terms of PCE, am I really like, oh my gosh, this changes everything? No. This is just like, again, it's Titanic all over again. Like, I saw this movie. I saw this movie on the jobs report. I saw this on the PPI report. I saw this on the CPI report. Why am I shocked that PCE came in hot? It's like the last indicator of the month. It's boring. It's like, thank you.